Hey everyone, and welcome. Today we are diving deep into a truly fantastic book, Learn to Earn, by the one and only Peter Lynch. Our goal here is to break down his legendary advice into simple, actionable steps that can really help you build lasting wealth. You know, it's a funny thing. Most of us work our entire lives for a paycheck. But Peter Lynch makes this brilliant point. Earning well isn't really about your salary. It's about making your money work for you. And that's exactly what this is all about. Lynch, who's one of the most successful investors ever, basically gives us a roadmap to financial freedom. He shows us how to sidestep the common mistakes and finally get our money to start doing the heavy lifting.
All right, so let's jump into the book's big idea, what Lynch calls the earning paradox. It's simple. Pretty much everyone on the planet dreams of earning well, but very few people are ever actually taught how to do it.
This quote, it just hits the nail on the head, doesn't it? We spend decades learning how to do a job, but almost no time learning how to manage the money we make from that job. Lynch's whole mission is to close that gap for us.
So, how do we fix it? Well, Lynch lays out this amazing toolkit of 5 core lessons. Think of these as the absolute building blocks for creating real, sustainable wealth. Okay, let's quickly run through them. First up, love what you do. Lynch is a huge believer that passion gives you a real edge. Number 2, avoid debt traps. Seriously, high-interest debt is an absolute wealth killer. It's like trying to swim with an anchor tied to your leg. Third, think like an owner. When you buy a stock, you're not just playing with symbols on a screen, you're buying a small piece of a real business. Fourth, invest in strong companies. You want to look for businesses that have a solid history and a clear plan for the future. And last but not least, patience pays. The stock market, as Lynch will tell you, rewards discipline over the long run, not quick, speculative bets. You know, Lynch has such a clever way of talking about lesson 2. He calls debt reverse savings. Just think about that for a second. With savings, your money is out there making more money for you. But with debt, it's the complete opposite. Your money is working against you, costing you more and more every single day.
And this brings us to a really crucial point. There's a limit to how many hours you can work at your job, right? But your money can work for you 24/7. It never gets tired, it never takes a vacation, as long as you put it in the right places.
So, what's the safest way to put your money to work? The absolute golden rule is diversification. We've all heard that saying, don't put all your eggs in one basket, and that's literally it. It's the #1 way to manage risk and protect your wealth over the long haul. Here's a really simple way to picture it. Instead of betting everything on one single thing, you spread your money out. You put a little into stocks, a little into mutual funds, maybe some bonds. What you're doing is creating a portfolio that's balanced and way more resilient to shocks.
Now, I get it. A lot of people hear the word stocks and they just get nervous. It can feel super overwhelming, and that's totally okay. But that's exactly why mutual funds are so great. They are a fantastic way for new investors to get started.
And one of the best ways to get into mutual funds is through something called an SIP, which stands for Systematic Investment Plan. Honestly, just think of it like putting your investing on autopilot. It's a super disciplined way to invest a small, fixed amount of money again and again.
And here's the best part. The part that really changes the game. You do not need a ton of money to start. With an SIP, you can get started with as little as 500 rupees a month. This just shatters the myth that investing is only for the rich. It's for everyone. The real magic of an SIP comes from 3 things. First, you get the incredible power of compounding. That's where your money starts making its own money. Second, you take advantage of something called rupee cost averaging. All that means is your fixed investment buys more when prices are low and less when they're high, which smooths out the bumps along the way. And finally, it builds that crucial habit of discipline.
Okay, so we've covered the how, but now let's talk about the why. Because when you invest, you're actually doing a lot more than just growing your own little nest egg.
See, every single rupee you put into the market becomes a tiny part of this giant economic engine. Your money doesn't just sit in a vault somewhere. It's actively out there helping to fuel growth for everybody.
Just think about the ripple effect for a moment. Your investment helps a company expand its business. That expansion creates new jobs for people. And more jobs and more innovation all add up to building a stronger, more prosperous country for all of us. Your own financial growth is directly linked to the country's growth.
And really, this is what it all boils down to. This is the core message from Peter Lynch. Building wealth has almost nothing to do with getting lucky or picking the perfect day to invest.
It is a journey, and it's built on a foundation of learning, discipline, and the simple, incredible power of being consistent over time.
So as we wrap this up, I want to leave you with a question to chew on. What's the one financial lesson you really wish you had learned when you were younger? Just thinking about that can be the spark you need to make it change today. Your learning journey can start right now.